Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Paul, really great to be able to catch up with you again. I feel like it's been a long time, but time has a different meaning these days. So anyway, great to see you. Thanks for doing this with me.
Thanks for having me, Catherine. Great to see you as well.
Thank you. I think that our viewers should understand that you have a couple different roles. You are the Chief Investment Officer. You have macro commentary, and then you also focus on the healthcare fund, the healthcare ETF that you have, which is, I think, really interesting to a lot of people. And part of course, healthcare right now is thinking about the biotech and pharmaceutical companies of the world, which we'll get to in a second. But just from a top-down perspective, as the CIO, what are you and your team thinking about as it relates to the new variant and maybe more coming?
So obviously the biggest concern as we start to feel a little bit more normal is, what does this next variant cause? What are the implications? And, we hear a lot of different statistics from various studies on vaccinations, what's working, what's not. And we've done some fairly big deep dives into the Delta in particular, but looking at what are the real implications of those that are vaccinated, what are current hospitalizations looking like? And I guess without delving into all the minutia of the data, I think what we can comfortably say is, we don't want to keep our eye off this because it's very real. But the tail risk of it having that sort of structural impact to society again, I think is very, very low. And so when we start to, even though in Canada it feels a little bit, the data also shows what we kind of feel here is when you look at the US, things look like they're open. That's because they are. And so the data that we look at also indicate that the things have very much reopened, and that the Delta, although it is capturing a lot of media attention right now, hasn't flowed through into some of the shorter term indicators that we look at, really gauging sentiment of people and their propensity to be out and doing, whether it's out shopping or whether it's out traveling, which is in a particular interest area for us.
Okay, so we'll get to that in a moment. But so what I'm hearing from you is that, and I've been in the States as well, and people there are just I think, done with being locked up, and they're carrying on, and that's kind of what I'm hearing from you. I think the question, though, for a lot of people is that the right decision? And from a pharmaceutical biotech perspective, if you're vaccinated, what are you seeing and hearing as it relates to getting the Delta?
So when we hear things like the viral load is 1,200 times more, even in those that are vaccinated, one can't sit back and think, wow, that's scary. But when you actually start to look at the hospitalizations, and one of the calls we were on just over the past week, the doctor was indicating that about 9 out of 10 of those that were showing up in hospitals were unvaccinated. And when we break out that other 10%, a significant proportion was from the were vaccinated with Johnson & Johnson, which we know now needs a booster. And so we know that you can still catch COVID and have the Delta, but it does seem like it is very much mild symptoms or asymptomatic, and hospitalizations in particular and deaths for those that have been vaccinated is very low. So when we kind of put that all together, I still think that and believe that the risk of any potential future shutdowns or anything that even remotely looks like what we had in March of this year or March in 2020, that's very low probability. And I think that actually has some positive implications for the market, for the recovery. But in the midst of this, when you hear scary statistics like that I just mentioned, or you see, charts indicating that cases are increasing, that they can tend to be, more intraday or day over day volatility. But the data that we're looking at does not match what we're seeing from some of that commentary.
The data doesn't match what the headlines are.
So that's correct, yes. So when we start to look at things, we like to look at travel, because that's, again, as I mentioned, we have a particular interest in that area, but also areas like when we think about restaurant bookings, which is actually nobody's ever come to me and said, hey, what statistic in the last pandemic did you use to measure the propensity of people's sentiment coming out of it? And so one of the areas that we thought would be interesting is looking at the restaurant bookings, which we can track weekly by every major city in most parts of the world, and a bit of a proxy on human sentiment, if you will, to actually be out. And so we absolutely see the week over week not changing there. It's weekly variations, but no significant rollover caused by the variant, caused by Delta. And we also see that with various types of other travel statistics, whether it's airline, passenger travel, whether it's the hotel, the revenue per available room. Those types of statistics are all still very much indicating that the recovery is intact.
So, I mean, a lot of points to pick up on, I guess. First of all, when you mentioned, well, this is it. I mean, it's really quite fascinating that the people who are getting the Delta variant, 90% are unvaxxed, and then the other 10% probably has J&J. Just to recap that.
Yeah. So that would be for the hospitalizations, and it's not the entire 10%. It was more of an indication that the bulk of those that are vaccinated are coming in with the Johnson & Johnson, and that's hospitalizations, not necessarily contracting the virus, where we still see some mild symptoms, or people are also symptomatic in testing.
Okay. I mean, that should give people who have had, who are double vaxxed some confidence, and probably more confidence than they're currently showing in terms of getting out and about, or at least here in Canada.
I think so. One of the it's quite interesting. We looked at the airlines and comparing, again, trying to measure Canada, and we can see it with that open table data that I was suggesting before across metropolitan cities in Canada versus those in the U.S. But also when we looked at the airlines, and just a simple, I recognize an analyst will point their finger and say that's not a forecast. Simply multiplying second quarter revenues by 4 to give a perspective on where we are relative to 2019. And in the U.S., they're about 65 to 70% of where they were in 2019, and so in Canada it's sub 20%. So again, we're perhaps a little bit later getting started. We were a little bit later getting our full vaccines as well. So, but we can see it also through May, June, July. Those bookings that I was referring to in restaurants have increased significantly. So we're starting to get a little bit more like what we've seen in the U.S.
And so where does that leave you? I'm kind of jumping into the investment side of it now, but where does that leave you then in terms of your investment outlook and really where you want to be positioned?
So I think there's two areas. When we look at investments, we want to look at medium longer term growth dynamics. And so I bring up the travel area because pre-pandemic, this is an area that was capturing a significant amount of growth above market. Baby boomers were really coming into their retirement years, and travel expenditures were significantly increased because of that, really from 2005 all the way through to 2019. So we think having exposure to that travel area, there's an opportunity. You do have to withstand some of the volatility in and around the day over day headlines, but when we look out 18 to 24 months, we do see that particular area as having solid growth and resuming that trend that was pre-pandemic. But the other area, and you mentioned this at the start, I co-cover our healthcare, and this area has seen some very, very positive macro backdrops because of the pandemic. And really one of the drivers for that sector pre-pandemic was sentiment. And it was very easy for politicians to simply put up the political lightning rod and point at the pharmaceutical companies. Yet these companies have pivoted massive resources and really shifted our lives, or transitioned our lives from what was, full lockdowns to something that's resembling more normal. And that they did that in unprecedented time. So I think the perception of the pharmaceutical companies has changed significantly. I also think the propensity for politicians to be pointing fingers at them at the same time has changed, coupled with the macro backdrop, of course, of a new president that has more centrist policies. So when I put that on one side of healthcare and I balance it with other areas like medical devices, which were shut down as well, that's an area of reopening that we're currently seeing in the first quarter and followed through to the second quarter, really sort of exceeding expectations as elective surgeries have come back. So it's an area that's still, market's trading at 20 plus times forward earnings. This particular area trades at a discount, but yet has visible growth at a time when some of the areas perhaps in the next 12 months don't have the same type of visibility. So we very much like healthcare as well.
And so just to pick up on a couple of points there, it was interesting when you take a look at the pharmaceutical companies, you almost have to get your head out of our COVID world right now and remember how much finger pointing there was at the pharmaceutical companies in terms of what they charge for drugs. I mean, that was a conversation we were having for a number of years. Obviously that's on the sidelines right now, but because of that, correct me if I'm wrong, but because of that, there wasn't a lot of movement in those stocks, and there certainly wasn't a lot of institutional interest in them from a money flow perspective. And so they didn't do anything, and now they are.
Absolutely, and we can see it. It's really come back down to fundamentals as opposed to more concerns about the macro political environment. There's proposals. There's always proposals within healthcare, but as I mentioned, the Biden administration tends to be more centrist in their policies. So the proposals that are out there for any type of reform are very, very modest, and so have very limited implications across the sector. So you hit the nail on the head that I think that the overall sector has become more investable from an institutional perspective as well, and so we're seeing that flowing into these companies. Of course, the vaccine, benefit for some of the companies, in particular Pfizer, that we think will be ultimately transitory. We will need some boosters, we think, over time, and it really comes down to these types of valuations on, say, a Pfizer. How do they redeploy that capital or that excess cash flow that they have now, and how do they redeploy that for future growth? So there are certain pockets that we like a little bit more. We do like the medical devices here, managed care. We think perhaps they're, like I said, on the Pfizer, for example, perhaps there might be a little bit of over expectations in the shorter term on the long-term benefits of vaccine boosters.
And for some of the pharmaceutical companies going back 15 years ago, I mean, the stocks also always moved or were interested or not interested from an investor perspective based on what their product pipeline looked like, and of course, patent cliffs. What's the latest there in terms of what that even looks like and how relevant it is in the discussion of owning pharmaceutical companies?
So great question. And so these companies do need to be reinvesting. Actually, one of our favorite metrics that we like to look at is R&D to sales. And so that's one of the metrics. We look at other types of productivity of their R&D, but we want to see companies that are reinvesting in research and development. So when we came through that major patent cliff, call it in the 2014 to 2016 area or time frame, we saw the companies, they really need to reinvent and really reinvest for growth. And so we've seen it. Actually, it's quite interesting to see a number of the larger companies, and I mentioned Pfizer, but Novartis was one of did this also, and several other companies have done it, which is they've spun out their non-growth assets, their kind of long life assets into other public companies or have sold them off, and so that they can become much more focused in on their R&D and their pipeline. So a long answer of saying that always is a a key for our companies. We really don't see anything 2025 across our pharmaceuticals and this on the large cap side and large cap biotech. We don't really see any major patents coming off, other than say a company like an AbbVie, which we know when these patents are coming, as well telegraphed into the market. And a company like AbbVie has just done a fantastic job. For those that don't know, they have Humira, which is nearly a $20 billion a year drug. They've been reinvesting that across multiple other areas and therapeutic areas, and really have built out a much more diversified business. And kind of that, I think that's a textbook case of management really executing well, and I don't think it's been accounted for in the market when you have something that has 10% growth and trading at a 9x multiple. I think the concerns are a bit overdone on that particular patent, but that's really the only one that we see. That's 2022, 23, and we don't really see anything else out until 2025, 26. So at least for the next few years, no major patent cliffs like what we saw in that 14 to 16 period.
Okay. And when you think about the med tech companies, and they are always interesting to take a look at when you're coming out of an economic downturn or a COVID related pandemic, because people now can go back and get more of the elective surgery. So I'm just kind of wondering though, who's kind of best positioned, because some of them, I haven't really looked at them much over the past number of years, quite frankly, but some are specialists obviously in knees, knee replacements or hip replacements. What's the area of medical equipment that you even want to have exposure to?
I guess the answer is yes, and that means all of it.
Oh, really?
I really think that I look at a company like a Boston Scientific, which is very heavy in cardiovascular related equipment. We see great growth in that particular company and very well executed. I guess if I were to have to pick one, though, I would have to say Stryker. Is one that we really like. Of course, they have. I always joke that if you go into a surgery, they have. You see a drill on the side. It's not a DeWalt. It's that's likely a Stryker drill. But of course, they have the all of the equipment associated with surgeries. If you've been into a stretcher and an ambulance, it's Stryker. But their growth comes from robotic surgery. They've made a number of acquisitions. They've got, this isn't a robot coming in and doing the surgery. It's robotic assisted surgery. So you still have a surgeon, just with their Mako system, becomes much more efficient and effective, in particular on hips and knees. They've made some acquisitions into other areas in the ankle and shoulder. And so that's an area that we think does have, if we look at kind of a 5-year plus time frame, they are the leader in robotic surgery and robotic assisted surgery. So I think that's a great, nice balance with sort of their traditional business, but the growth really coming from the robotic surgery.
And what's reflected in the stock price right now?
So it's been fairly volatile. You end up the valuations are a little bit up on. I shouldn't say up. You tend to pay a little bit more in the medical devices companies for the growth that is there. Not dissimilar that you see in technology companies, that you do have a little bit higher multiple. However, what we've seen with Stryker and with Boston Scientific is they tend to also be fairly volatile in and around kind of that reopening and the discussions around Delta in particular over the past few weeks, but also Q1 they gave indications that things are starting to recover, that elective surgeries are coming back, and that was validated with really solid Q2 numbers, up guidance for the rest of the year. So fundamentally, they're seeing the recovery happen in their businesses, but there's still that uncertainty around Delta. And of course, are we going to see elective surgeries slow down again? And that really has caused a little bit more volatility in the shorter term. So we see any of that type of volatility as opportunities to be adding to that particular area.
Interesting. How does the robotics though compare to Intuitive Surgical, which is a company I actually when I worked at Deutsche Bank, Deutsche Bank tended to cover some of the smaller cap companies back in the day, in part because of the merger with Alex Brown so long ago. So, I was introduced to Intuitive Surgical really like long before it became a mid or large cap company. So it's been a fascinating growth stock to watch. I don't know if you have views on that stock and or how it compares to Stryker's robotics.
And so a great question, great point, and blast of the memory as well from those days. And so absolutely, they've been also a leader in robotic surgery with Intuitive. I don't have the multiples in front of me, but I want to say you're paying almost double the valuation on an Intuitive versus something like Stryker. That would be my preference. A little bit lower multiple. You have not even a little. You have a much more diversified business base as well. In a Stryker, as I was mentioning, you've got all the other traditional business lines. So perhaps not as much growth. But when I look at the multiples, like I said, I don't have it in front of me, but I want to say it was double that of what a Stryker was last time I looked, which was about a week or so ago. So I'd rather have something a little bit more diversified and perhaps a little bit less torque because as we know, when the growth doesn't show up, that torque can go the other way sometimes too. So we prefer a little bit more diversified business line.
Fair point. What about in the dental area? Invisalign is a company, again, that I've looked at for years. And it had been a great stock performer. Then, of course, Smile Direct came in and kind of caused some question marks in terms of whether or not, it would dent or take sales away. What's your view there?
To be honest, I don't really have one. Align really hasn't been a name that I've covered. So, as opposed to coming up with an answer that doesn't make sense, I haven't covered the dental market as much as sort of traditional medical devices.
Yeah, no, that's fair. It's kind of people either follow Invisalign or Align Technologies or kind of not. But I do think in your fund, and correct me if I'm wrong, but do you own Thermo Fisher Scientific?
We do. We own Thermo and recently added to our Agilent, and so we like that tools and diagnostics businesses. We think that. Not just from, of course, there's a little bit of a COVID bump, but also from increased R&D across business, across the large cap biotechs, mid cap, small cap biotechs. We think that flows through into the tools and diagnostics areas.
Which is Thermo's main business. It's just kind of usables, reusables, correct?
That's a proportion. I don't have the exact proportion off the top of my head. They do have reusables, but then of course, if you go into a lab and you look at the actual lab equipment itself, will quite often be Thermo Scientific, and of course, that's not just pharmaceutical labs. But that there also is some academic research that's associated with healthcare as well. So they would have the recurring revenue is really on the reusable sides versus when all of the lab equipment associated with diagnostics is also Thermo Scientific.
And Paul, when we talk about your healthcare fund, explain to me, and it's interesting because these are high quality, large cap names that you guys seem to have an interest in buying, correct?
That's right. So we've got a very narrow universe of companies that we look at, and so we have a minimum 5 billion market cap. We've never gone under 10 billion. We really want to own the large dominant companies in a broad diversified portfolio of healthcare companies. And so that ranges from, we haven't talked about managed care, which is insurance-like, through to the medical devices, pharmaceuticals, and large cap biotechnology companies. So we have 20, we're equally weighted, and we go through each quarter and we run various quantitative metrics. So we're very much numerically driven, but we also, when you peel back the layer of our portfolio, we want to make sure that we're not overexposed to any one particular area, whether that's pharma or medtech, but also peeling back the pharma in particular, we want to make sure that we're not overly exposed to any one particular indication or one particular therapeutic area. So we want to have a diversified portfolio of large healthcare companies. That's in a simple way.
Right. And but income producing as well. So when I looked on your fun fact, it shows that the dividend is 1.75, but the yield is 8.17%. Can you explain that?
That's right. So we have what's called the covered call strategy. And so the covered calls are really, we forego a little bit of the upside on the underlying stocks. We sell call options on the underlying positions. It's up to 33%. On any one position. And that's not just a random number. It's learned over a long period of time that still gives us 2/3 of the upside at all times. So meaning we'll always have 67% of the upside on our individual positions. But every month we collect cash flow from selling these call options on up to 1/3. It's quite often closer to 25%. And so what that allows us to do is, again, it's a quid pro quo of getting cash flow monthly versus foregoing a little bit of the upside on the stocks. And that allows us to pay out that additional cash flow. And because the taxation of the covered calls is considered capital gains, that also allows that cash flow to be quite tax efficient for unit holders as well.
Sorry, can you explain that last part again? Why is this efficient to write covered calls?
So normally a dividend would be, if it's a U.S. dividend, that would be considered a foreign income. And so the taxation, the way that we do it, is considered a capital gain. Oh. And so when we pay out that distribution, it's not just an 8.1% income stream, it's a proportion of income, and a small proportion from the dividend income, and then a proportion from capital gain. So just adds a little bit to the tax efficiency of that distribution. And again, the quid pro quo is that you don't have the full upside on the underlying positions. And so when we talk about HHL and healthcare leaders, we really try to point people in that if you're looking for healthcare and monthly cash flows, that's really where healthcare exposure and monthly cash flow, that's where healthcare leaders comes in. If you're just looking for cheap beta to the sector, then there's probably other alternatives for you.
But that's really interesting. So the cash flow on this fund is an 8% yield. Is that right?
That's right. That's right. And so
paid out monthly?
8% per annum paid out monthly. And so to peel back the layer a little bit on that, each month we go through and we look at our portfolio with a fixed distribution, and we say, how much on each individual name, how much covered calls do I have to write in order to generate the net after withholding tax, after fee cash flow for that particular month. And I don't want to overly complicate the strategy, but each month it's not the same. So different things give us more premiums or cash flow each month. So typically during an earnings season period, we have higher volatility expected. So we end up generating more cash flow during that time. Healthcare is very unique though, in the sense that we're always tracking what are the pipelines looking like? What are the catalysts coming down from drug trials? What are the industry conferences that are coming? Because each one of those will tell us why we're getting paid a certain type of premium on a particular stock. And it's sometimes not even that particular stock's premium or catalyst. It's a competitor, and I think of Eli Lilly recently with Biogen, which we don't own. We own Eli Lilly. Biogen had an Alzheimer's regulatory event that was expected to be a very big market moving event for them. Eli Lilly has a similar type of drug, which will flow through. The market knows this, and that allows us to actually go out and say, oh, that's why I'm getting a very big premium this particular month. And so we do that every month, and we go through and determine how much we have to write based on the live market at the time.
No, I'm glad we talked about it, because I think that's something that, investors, it's difficult to do definitely on your own, because you actually have to have a real understanding of what's going on the company fundamentals, and of course the competitors, as you just described, to be able to capture that premium when you write covered calls. I actually wrote some covered calls on Moderna, and because it was more volatile and kind of a pure play COVID wise, the premiums were very good and are very good, but of course the upside in the stock far surpassed anybody's expectations. But I only did it, to your point, on a portion of the holdings, so I guess it's okay.
Yeah, I can certainly empathize. Some people when they think of volatility, we actually like when we see that. We get paid more on our options when things are volatile.
Yeah, you definitely do, and it is a nice way to generate cash flow. Period.
For sure.
Yeah, no, it's an interesting and great strategy. Why don't we just kind of close here, wrap it up, and maybe just provide some parting thoughts, as it relates to being the CIO of the firm. And I don't know, maybe we see a correction between now and year end, but perhaps as we look into 2022, what investors need to think about.
I could talk on a few different angles, but I really kind of bring it back, Catherine, to when we look at what's happened. We've come through a pandemic. We've come through the recession. A huge amount of liquidity has been put into the system. We saw a lot of market rotations earlier this year. Growth to value, momentum to large cap, and there was a lot of moving parts. And when we look back at that retrospect, to me it was a bit of a mid-cycle rotation. And so I think that's where we are right now. We're in the mid-cycle. We're sensitive to changes in the day over day media, if you will, from COVID, but not realizing that there is a low tail risk that it does have a systemic impact. But I think that's a very low risk. And when I look out kind of the next 12 to 18 months, we've been growing into earnings. We think that that's going to be the case. The actual economic system and the recovery that we've seen, we think is very much intact. Could we see a 5% pullback? Could we see 10%? Absolutely. You see any of these sort of catalysts or tail risks, really taking hold, you could see that. But I firmly believe that when we look out 18 months from now, or even 12 months from now, that in aggregate, there's great opportunities. And like we're talking about on the options, any of that type of volatility should be used as opportunity. And so try not to be scared. We like being invested. We're invested in our funds. And so, with the macro clouds that come in and go out, really focusing on just owning good quality businesses that are in areas that have structurally positive backdrops. And I think we touched on two of those, which is healthcare and kind of in that travel related recovery as well.
Mm-hmm. Absolutely. Well, Paul, we will leave it there. That was great catching up with you. A lot of great information, insights, thoughts for our viewers. So thank you.